So with the importance of a historical perspective clearly in mind, one of the things that's identified by this scholarly book by Reinhardt and Rogoff is what they term "this time is different" syndrome. Okay, so the thing to watch out for here is a certain overconfidence combined with a failure of imagination, and we've seen this all too recently with regard to the recent coronavirus pandemic, for example. So throughout human history, as far as economics and finance is concerned, the belief has been held that financial crises are things that happen to other people in other countries and at other times. So often this time is a little bit different, but it's not as different as to preclude learning valuable lessons from history. So it is easy to be dismissive here. I think this relates to deep-seated aspects of human behaviour and indeed the human condition, but misguided beliefs include things like we are smarter, we have learned from past mistakes, old valuation rules from accounting and finance don't apply, and in a similar vein, a SARS pandemic like the current one is impossible. Okay, so whilst these are misguided ways of thinking, these do relate to deep-seated aspects of human behaviour and the human condition, so one shouldn't be too dismissive here. Okay, so the natural question to ask is this time really different? So it's important, if you look at the historical perspective, to recognise that crises can occur irrespective of sound economic fundamentals, structural reforms, genuine technological innovation and good policy. Okay, and there are, for instance, lots and lots of examples where technological innovation was not matched with commercial success. So this is far from a historical curiosity. So Reinhardt and Rogoff, in their book published in 2009, discuss several crises across both the 20th and the 21st centuries, ascribed to what they term this time is different syndrome. Okay, so this is linked, as I said before, to deep-seated aspects of human behaviour and the human condition. And I would say this, that evolutionarily stable human preferences for risk, return, greed, etc. mean that bubbles and crashes are inevitable in some form or other. Okay, so you can view blockchain certainly as a genuine technological innovation. This doesn't mean that blockchain and Bitcoin will not be associated with financial crises and deep-seated speculative bubbles. Okay, bubbles are inevitable in the future. So with this importance of the historical perspective firmly in mind, it's instructive to revisit the global financial crisis and what Reinhardt and Rogoff call this time is different syndrome. So this gives a contemporary example of sadly wishful thinking that has certain pertinence to things like Bitcoin. As far as the global financial crisis was concerned, sadly wishful thinking that the financial system was now superior to its predecessors, sadly wishful thinking that we understood monetary policy and incentives better than ever before, and the critical weakness, as discussed in Reinhardt and Rogoff, is that you had banks with too much money to fritter away on speculation associated with obscure mortgage-backed securities. Okay, as further examples of sadly wishful thinking, this mode of thinking also ignored potential downsides of things like globalization and new technologies, and in some cases excessive liquidity. And the clear lesson from this is intended to reinforce that you ignore historical parallels at your peril. So within this is some very deep-seated ingrained human weaknesses, certain failure of the collective imagination and overconfidence, like I'm afraid to say we've seen with elements of the recent coronavirus pandemic. So there are some important parallels here when we draw on the historical experience with respect to Bitcoin and blockchain. So you could certainly say here that valuation is unclear given historical norms, and this is very similar to the internet bubble from 1996 to 2000. Blockchain represents a genuine technological innovation, and there is doubtless genuine innovation associated with cryptocurrencies. However, This has been previously identified with past bubbles and crashes and crises, and is termed "this time is different" syndrome by Reinhardt and Rogoff. Often you get during respective bubbles an influx of new investors. What is key here is this overshooting model of zero, published in 1999. Despite genuine innovation, it is unclear if Bitcoin may ultimately be overhauled by something else. So again, if you look in the historical archive, there's lots and lots of examples where technological innovation was not associated with commercial success. History is replete of examples where people lost money despite genuine technological innovation, and house cleaning function associated with financial crashes suggest the episodes sought truly profitable from purely illusory opportunities, but somewhat brutally. Okay, so in conclusion then, what we try to discuss in this lecture is the importance of financial bubbles and crashes. That's certainly something to bear in mind with respect to very volatile behaviour that's been witnessed on Bitcoin markets and other cryptocurrencies. Financial bubbles and crashes are inevitable in some form or other due to deep-seated, evolutionarily stable preferences for risk, return and greed, etc. They're often also associated with these two things here, either new technology and or an influx of new investors. Bubbles and crashes are of specific interest to Bitcoin and blockchain due firstly to this lack of central governance structure, so there's nothing to dilute these bubble effects. The contrast, if you look at something like the FTSE 100 stock index, if there was a dramatic bubble on this index, the Bank of England might act, so this would necessarily restrain some of the bubble effects that you would observe. I think you can certainly argue as well that Bitcoin and blockchain are inherently speculative due to uncertainty around the economic definition of Bitcoin and blockchain. This inevitably gets complex when you begin to separate the notion of money from the nation state. Historically as well, we've seen extreme price risks almost unique to cryptocurrencies on these markets. The economic model there, published in 2018. So in conclusion then, bubbles remain inevitable in some form or other. They've happened for millennia throughout human history. Indeed, what is remarkable, I think, is just how far back you can go and still see pertinent historical examples. Bubbles are linked to evolutionarily stable human preferences for risk, return, greed, etc. So will always be present in some form or other. Bubbles and over-optimism probably inevitably accompanies new technology and its adoption when new inventions come into being. A key example here would be the blockchain technology. However, expect brutal competition between winners and losers. So you've seen some aspects of this volatility when you look at historical cryptocurrency markets, but expect a lot of brutal competition far beyond that. What I think is useful to re-emphasize here is that bubbles and crashes are a big topic. They are bigger than any individual and any individual discipline. Useful insights can be variously given by mainstream economics and finance, but also psychology, history, physics and mathematics. Now I keep trying to emphasize the importance of the historical perspective. It's also surprising just how far back in time you can go and still get pertinent historical examples. So historical perspectives are likely to be the only insights that won't date immediately, and indeed, as I just said a moment ago, it's surprising how far back you can go and still see pertinent examples. The book by Reinhardt and Rogoff is very scholarly, and I'm grateful to get a chance to read this preparing these lectures, but this is not bedtime reading. Nonetheless, it's well worth a look. The historical experience, motivated very much by Reinhardt and Rogoff, suggests several key lessons. So be wary of unintended consequences of bubbles and speculation, especially if the conduct of banks and other financial institutions remains unchecked. Beware this time is different syndrome. So this time may be a bit different, but is it different enough to ignore historical parallels? There's a danger of increasingly severe booms and crashes. The pertinent warning in Reinhardt and Rogoff that new technology didn't eradicate warfare, it only made it more deadly. Beware also this unhappy potential distinction between technological innovation and commercial success. So the examples I've used in lectures include Porsche versus TVR, VHS versus Betamax, and Concorde. Other examples my students have come up with have included Google Glass. As with some of my previous lectures, it's perhaps worthwhile spending more time going through these references than would ordinarily be the case on a lecture course that I give. So this paper by Blanchard and Watson is one of the early key papers on rational bubble models. So these models are important conceptually because they allow for bubbles to occur without mass irrationality on behalf of the market participants. So this is, I think, a realistic assumption. The paper by Baldwin and Levine, Growth Cycles and Market Crashes. So this was trying to emphasize the role played by technology shocks rather than information. This is an interesting idea, but I don't think it necessarily fits very well as a model for Bitcoin blockchain. So the paper there, Che and Fryer, is my first paper published on Bitcoin. It's now been published 6 years and been cited over 700 times. And then the book there by Kevin Dowd is very useful, I think, for a discussion of various background economic issues and how they apply to Bitcoin. Also interesting for a separation between technological innovation and commercial success that has been noted historically, certainly in relation to, say, VHS versus Betamax in the market for video cassettes. So probably the most important paper on this slide is the paper by Johansson et al. In 2000. So the idea here is that you have this risk-return interplay and a rational bubble. So bubbles happen as a representative investor is compensated for the crash risk by price increases. And amongst other things, this idea was expanded upon in my 2018 paper published in Economics Letters. So this paper argues that as this return happens, there's an implicit acknowledgement that prices in cryptocurrency markets can collapse completely. So this is grounded both in a mathematical model but also with the empirical, historically observed experience. And the fact that these cryptocurrency market prices can collapse completely is true long before Bitcoin even. A paper published there in 2016 we won an international best paper prize for. So I think it's worthwhile mentioning this paper here because the cryptocurrency market changed dramatically just a week after we had the paper formally published. So these things can move very quickly. And then the interesting idea there, drawing on the analogy between market crashes and informational avalanches, but like an earthquake in Lee 1998. So the paper by Osborne 2001, I think this is interesting for its description of bubbles and crashes serving a brutal house clearing role, sorting out between truly profitable opportunities and merely illusory ones. And it's important to have in mind the economic processes that underpin what you can observe. A very scholarly book by Reinhardt and Rogoff on economic and financial history, characterizing and popularizing this notion of a this time is different syndrome. So perhaps this time is a little bit different, but perhaps not different enough that you can ignore important historical parallels. The book by Schiller in 2005, so Schiller won the Nobel Prize in economics. I think this is an interesting book, although the title actually is perhaps a little bit misleading. It's often more useful to think of these things in terms of rational bubble models. The paper by Yermak, so is Bitcoin a real currency? So there's two key objections to this. Firstly, excessive speculation. Secondly, the potential separation between money and the nation state. And then the paper by Zera, 1999, I would describe this as a modern classic. Two key ingredients to bubbles, usually either the development of new technologies or an influx of new non-traditional investors. And again, important to look for the underpinning economic processes that go behind the behaviour you observe.